And with that, I will hand it over to my colleague, Kim Campasi. Most of you know her. A lot of you attended our first webinar back in February, where I did a more formal introduction. But she is one of the co-founders of Motive Retail, and I know has personal relationships with most of you. So Kim, with that, I'll hand it over to you to do a quick introduction and introduce our speaker today.
Right, good stuff. Thanks, Natalie. And hello, everybody. So today is a little bit of a continuation in some respects of the theme that we started in the last webinar that we did, where we talked about the proliferation, frankly, of systems, dealer systems, more specifically, in the market, and what that means for the dealer networks, what that means for many of yourselves from the OEM perspective. And today's topic and what a lot of what Steve is going to take us through is like I said, a little bit of a continuation of that, because obviously the proliferation of systems is being funded somehow from somewhere, and this is an aspect of the market that certainly when I started in this space 20 years ago, that was not the case. There was not investment flowing into automotive like there is today. So Steve Greenfield, who we are delighted to have with us, and thank you to Steve for joining us. He is founder and CEO of Automotive Ventures. So for those of you who might not know Automotive Ventures or Steve, they are a leader in fundraising, growth strategy and transaction support for a whole host of auto technology entrepreneurs. And Steve's been at this for I think about as long as I have, Steve. So you're in good company, and so a wealth of experience in the market, in the systems. I think he started selling software to dealers earlier in his career. So thank you, Steve, for joining us, and let's get going. And Natalie, I don't know if I do have controls, but let's take them off me and make sure Steve's good to go.
As soon as he speaks, he'll be in the spotlight.
All right, great. Well, thank you, Natalie, and thank you, Kim. It's great to be here today. And as both Kim and Natalie said, really want to foster more dialogue than presentation. I've got a bunch of slides and a bunch of content that I'll walk you through, really to frame up, as Kim said, what's going on in the industry in terms of areas of investment, who's investing, how much they're investing, and some of the more intriguing transactions that are going on. But if at any time during this, I believe you can use the Q&A or the chat function within Zoom here, or just sort of virtually raise your hand if you're brave enough to speak. If you want to stop me, midstream here and ask any qualifying or clarifying questions, please don't hesitate to do so. And we will reserve a bunch of time, as Natalie said, at the end for additional questions. So with that, I'll dive right in. Hopefully everyone can see my screen. But we've got, being in auto is an interesting time. As Kim said, I've been in auto now for about 20 or 21 years. And, I do believe that it's not cliche to say that in the next 5 or 10 years, we're going to see more change than we've seen probably in the last 100. And that includes, the internet coming in and disrupting a lot of things and really evolving. But it just seems like we're at the precipice now of a whole bunch of dynamics that we'll get into today that are going to be changing things. And for some, that's daunting and intimidating. For others, including me, it's an exciting time. I mean, having now invested the majority of my career in automotive, as I imagine a lot of us on the call today, I mean, the change that we're going to see in the next few years is going to be pretty miraculous. And that's not to say that like a few years ago, where many of the consulting firms were predicting that by 2025, most of the vehicles on the road were going to be autonomous, despite some of these more aggressive predictions in the past, which aren't going to play out, obviously. I think we are going to see a tremendous amount of change in a number of areas that we'll get into today. So with that, let's talk about the auto industry. I moved ahead one. Huge, I don't have to explain to all of you. All of you are much more subject matter experts around automotive than I am and play in different areas of sort of this ecosystem. But when you look at global GDP, the global economy that's impacted by automotive, and you layer sort of the different areas upon each other. I mean, 10% to 15% of global GDP is impacted directly by automotive and mobility. And, you know, as you go around sort of this ecosystem here on this diagram and look at like the magnitude, you know, in the billions and trillions of dollars, it's quite amazing to think through sort of, you know, myopically when I started was really thinking through sort of like a new or used car sale and, you know, what a dealer or OEM would attach to that. But there's this whole ecosystem, you know, in terms of like the average car being on the road for, you know, 12 years, and that car going through wholesale auctions probably 4 times during its life cycle. And, you know, it may be owned by 5 or 6 individuals over its life cycle. And every time there's a transaction, either facilitated through a car dealer or peer-to-peer, but there's financing then, and there's opportunities for insurance contracts, and there's servicing of cars. And then not to mention, you know, everything around battery technologies and mining to get the raw constituents for batteries, public transportation. And as we'll get into here shortly, you know, a whole new slew of emerging technologies and companies, billion-dollar companies in automotive data, harvesting data off of vehicles, and how that's going to have to interact back with the DMS, and how, you know, we're going to allow consumers to protect their privacy information as that data comes off of vehicles. And then, you know, I have the opportunity to have very interesting conversations or debates with other investors in the space on a weekly basis around who will own the data. So, you know, as we get into connected cars in the future, and your car that you're driving is going to predict when a key component might fail, and the car is communicating with you in real time to say, hey, Steve, you know, it looks like there's a 90% chance of a component failing. You better go in and get the car serviced immediately. Well, the car is going to be able to go check who has the part in stock and who has availability in their service lanes. But is it going to be the dealer that sold you the car that's going to be able to have that communication with you? Or is it going to be the OEM that's having that relationship and communication with you? And depending on if you ask a dealer or if you ask an OEM, as you can imagine, the answers are quite different. So we are, you know, not the least of which in the US is with, you know, Tesla contesting state franchise laws, and, you know, the dealers lobbying to push back to say these new EV only manufacturers can or cannot sell directly to consumers within states, setting a precedent. I think we're also going to see, you know, tension in the future around data and who owns the data, whether the consumer permits their data to be used. And then, you know, the tension between a dealer who sold the consumer the vehicle and that OEM. The OEMs, for the most part, and I know there's a bunch of OEMs in the car today, when I speak with them, they're really focused on the consistency of the consumer experience. And I have to believe within a few years here, as we reach a tipping point where the majority of vehicles are delivered to a consumer's driveway without necessarily interaction face-to-face at a dealership, the consumer is going to, like they would with Apple today, they'll presume that they're buying the car from Toyota or from General Motors, and think less and less about the franchise dealer being an entrepreneur, and, you know, any reason to go visit like this franchise dealer, as opposed to, oh, I buy my car from Toyota, I get my car serviced from Toyota. And I would think that we're going to see more of a movement towards that as a new generation of car buyers come into the market. So it'll be interesting to see these dynamics, but I think we're in for, you know, the short version is we're in for a lot of change in the future. It's a huge vertical across the globe. And no matter what happens with subscription versus ownership, mobility will be very, very important and continue to be important in the future. And I'll say, Kim, we'll get everyone a copy of these slides if they need them or if they want them. So you'll have the slides as well. So no need to take notes because you've got the slides coming immediately after this presentation. Next, let's go into the auto tech landscape. So this slide is one that I maintain for my monthly newsletter, and trying to make sense through the lens of either an OEM or a dealer in terms of all the different areas. And I mean, I can throw a lot of arrows at this, and probably I need to go back and revisit this now through the lens of, it seems almost with every month that I publish this thing, there's a new category that I'm trying to shoehorn into this landscape. And we're almost at the point now where it's too hard to read the logos. which I guess is the message here that, I'm always amazed and really appreciate being able to go to our industry conferences every year and see the sheer magnitude of new innovators that are coming up with solutions, many of which Kim and her team help integrate back into each other and into the DMSs, which is good because it keeps business, I'm sure, going for Kim. But it's amazing to me to see how much innovation takes place. And I think it's really a testament to or attributable to the fact that it is such a big vertical. There's just so much money in the mobility or transportation space. And you've got, no matter where you look, there are opportunities to improve. So entrepreneurs are always finding opportunities to build new solutions. And then all these solutions, in many cases, need to figure out how to communicate with one another. So, and that's a challenge. Kim can speak much more elegantly and eloquently to that than I can. But it's always a challenge and always a point of frustration for any of these solution providers to figure out, how do I get the data that I need, and how do I ensure that I can communicate with other vendors that a dealer or an OEM are using to make sure that things work seamlessly. And this is one of the things that keeps automotive, for me, very interesting, is there's never a shortage of new innovations coming on to address some of the pain points within the industry. So anyway, so just to put into context that there is a lot of innovation going on, and there will continue to be a lot of innovation going on, not the least of which is because, as Kim said at the intro, there's a lot of new money that's interested in automotive, and we'll get into that next. So what's going on? So this is an interesting chart to follow. This is a company called the SAAS Capital Index, as it says at the bottom of the slide. This shows for publicly traded software as a service companies, what the multiple is of revenue. Now, historically, I went to business school, and companies would be valued on a multiple of earnings or EBITDA. Now with software companies, they're typically valued on a forward-looking multiple of revenue. And that has reached, obviously, from the chart, an all-time high. We're trading out about 16.5 times forward-looking revenue. So again, that's not 16 times EBITDA, as many of us may have grown up understanding how to value companies. We're looking at 16 times revenue multiples and forward-looking revenues at that. And but this is just a testament to Wall Street and individual investors being enamored with the SaaS model. So whether you think of Uber, or whether you think of Slack, or you think of Netflix, the valuations for these pure software companies that have very, very high gross margins, and the incremental cost to serve one incremental customer is negligible. So most of the profit flows through. Recurring revenue with very low churn and high growth means that investors really have embraced the SaaS model, which, as you can imagine, if you're an entrepreneur and you're saying, where am I going to focus my energies? If SaaS companies are being rewarded with these kinds of multiples, then of course entrepreneurs, both the VCs and the private equity folks, are looking to invest in these kinds of companies to get kind of rewarded with this kind of multiple if the companies are successful. But then the flip side is there's a tremendous amount of innovation going on by entrepreneurs trying to figure out, how can I solve needs within automotive and do so with a SaaS model, because I want to achieve multiples like this. And we'll get into more of that in a moment here. I have two charts here, and I published these in my last newsletter, so the numbers are a little out of date, but proportionally this is good. So I wanted to show two things, right? On this chart, I wanted to show all of the publicly traded OEMs in the world and how their combined market capitalizations were compared to Tesla's on the left-hand side. Tesla gets a lot of press. One might argue an undue amount of press because of their founder, but whether you're a Tesla fan or not, no one can argue that they built a massively valuable company at this point. And it's interesting to see how Tesla's market cap compares to all the other OEMs. And I would imagine that we've got representation of a bunch of these OEMs on today's call, but again, we'll get you the slides. But to me, it's a bit of a head scratcher, but it just shows you how much faith there is in Tesla's ability to continue to grow at the pace that they're growing. And I'm sure we could have a 1-hour debate today about whether or not they deserve that valuation. But in any case, it's interesting just to have this perspective, because it's almost to the point where Tesla's market cap is the combined market capitalization of every single OEM on the face of the planet, which is a bit of a head scratcher. And then the other one I wanted to show you was just in terms of the dealer groups, because a number of the US dealer groups are publicly traded, as you can see on the right-hand side, including CarMax, and I threw in there Vroom as well. But Carvana's market capitalization, which I think currently is bouncing around $50 billion. Again, not a dissimilar sort of graphic, and I kind of did that on purpose, not to necessarily compare Tesla to Carvana, but both of which are sort of Wall Street darlings right now for different reasons, but they are definitely like perceived to be sort of quote unquote disruptors. They've taken the business model and changed it. And as you can see from some of the folks on the right-hand side of the chart here, being probably most notably CarMax and Lithia. Lithia, I think maybe up to 13 billion in market capitalization recently. But Lithia recently launched a brand called Driveway, which is their national brand, under which they'll aggregate all inventory and offer a Carvana competitor. So you can go to driveway.com to see that. And if you've been paying attention to CarMax's quarterly earnings calls recently, they've talked a lot about their omni-channel experience in an attempt to offer an experience very similar to Carvana. They will now allow consumers to start their shopping process online. And if they wish, they can get driveway delivery to their home and or curbside delivery at the store. Or if a consumer wants to veer off of that and at some point and go into the store and finalize their sale in the store, they can do that as well, because CarMax, unlike Carvana, has physical stores. So it'll be interesting to see how the folks on the right-hand side of this chart start to mimic and learn sort of from Carvana and offer more of an online omni-channel, call it what you will, online experience with driveway delivery. I think to me, driveway delivery is sort of inevitable for probably a rapidly growing segment of consumers, simply because of the convenience factor. And I think COVID has fueled that. All of us who have Amazon in our areas, I know I get packages literally every day to my doorstep from Amazon, and it just, the convenience factor far outweighs me having to go into a store and have to shop and then have to risk that items aren't in stock. And I think as consumers grow up and are conditioned to having the convenience of things delivered to their doorstep, I don't see why we aren't going to have consumers demanding, both car deliveries to my doorstep and probably also servicing. Dealers will make it very, very easy for consumers to just summon someone to come pick up their car to have it serviced. And we can debate that as well. Again, if you have any questions at all, fire them off in Q&A, or don't be shy to raise your hand if I'm stimulating any thoughts. So let's transition then. So we've talked now a little bit about these valuations. Some would argue inflated valuations, software services, and then more specifically, Tesla and Carvana. Let's transition into taking a look at what's happening as a result. So what I've done here, and I know it's a little bit of an eye chart for those of you who are on a small screen, but there was one brand in particular I want to call out here. But this is an attempt to capture what happened last year in 2020 in terms of financings or acquisitions. And as you can see here, I mean, a whole slew of activity, despite the fact that we had a few months there during COVID where there was not a lot of investment or M&A activity, as companies were more interested in stabilizing their operations. And the VCs and the private equity folks were more interested in making sure they worked with their current portfolio companies to stabilize them. There's a brand here in the middle. I don't know if you can see my cursor or not, Kazoo. And I actually just published on LinkedIn this morning the investor deck. But this is an interesting company over in the UK. For those of you that are dialing in from the UK, you can probably talk more about this than I can. But I've sort of been tracking this company. They only launched the product less than 2 years ago. So it was July less than 2 years ago. And they are about to be public at a $7 billion valuation. And to put that in perspective, so they are what I would call an online reseller of cars. They look a lot like Carvana, but in the UK market. And they're starting to move into continental Europe, but mostly their business in the UK. And to put it into perspective, they have 7,000 cars in stock. And so far they sold 20,000. So there are dealers in the US who have that size business, who I can tell you would be nowhere near, maybe 1% of a $7 billion valuation. But you've got a founder who's a serial entrepreneur who's been very successful with exits, telling a story that sounds a lot like Carvana. And as we saw 2 slides ago, with Carvana having a market capitalization of between 40 to $50 billion, it sort of makes sense comparatively that there should be some player in the UK that might be worth something around 7 billion. But at the same time, a company that's not even 2 years old that has 7,000 cars in stock and has sold 20,000, one might argue that it's a bit of an inflated valuation. But they'll be public within a few days, it looks like here. Definitely a stock to track. I'm not one way or another endorsing whether you should buy the stock or not, but definitely if you're interested in getting that investor deck, it is available online. If you just Google Kazoo investment presentation, you can get that, or I've got a copy if you'd like me to send you a copy, but it's definitely worth looking at. And it's a frothy market with very high valuations right now, which I think is scary to me in some ways. But the flip side is that there's a lot of money sitting on the sidelines, both in VC bank accounts and private equity bank accounts that was not deployed last year because of COVID, and interest rates are at an all-time low, stock markets are all-time high, and the U.S. and other countries are about to benefit from this big stimulus that's going to go out into consumers' bank accounts, which should continue to increase the flywheel around investment in the economy. So I think that we'll continue to see this year being very, very active. And I would presume that when I build this slide next year for 2021 transactions, there'll be many more of them, and many larger deals on here. Not the least of which will be Kazoo's upcoming listing. So interesting times in automotive for all of us. And like I said, we're going to see a lot of change here, not the least of which is being fueled by a lot of money being spent and invested.
Steve, just a quick question. I'm not personally familiar with Kazoo, and maybe others are. Are they, the 7,000 vehicles or the 20,000 that they've sold, are these used vehicles primarily, or are they also striking up relationships with with OEMs to essentially become another, franchise type dealer like we're used to? And
yeah, it's a good question. It's primarily used as far as I know, but others might be more subject matter experts on it. But they did buy, you can see here, right here, Imperial Car Supermarket in the middle of last year, which I believe gave them some new car brands as well. So now they're able to do driveway delivery for both new and some new car brands in addition to used. But I think primarily it's a used car marketplace like Carvana.
Got it. Okay. And another one that's on this list that I think there's some folks that are probably interested in is of course the CDK Global, or the international piece of CDK. Any thoughts on that? That was an awfully big deal.
Yeah, so that's up in the upper right-hand corner here.
Yeah,
so CDK spun off their international operations. CDK just really struggled with ever getting that to profitability in the past. It was, and again, there'll be people on the phone or on the call here today that I'm certain are much more familiar with this than me. But following that over the last few years, it was really stitched together through a bunch of acquisitions in different countries. And I think the thesis was, if they could establish relationships with the OEMs, many of whom are on this call today, then they could kind of, get buy-in for OEMs to push down on their dealers within certain countries. I just don't think that they ever successfully really rationalized the technology stacks as they made acquisitions across these different countries. And for that reason and others, it was really hard for them to get that international operation to profitability. So it's been rebranded to Keyloop, if you saw that recently, so no longer CDK Global. It puts a lot of cash on CDK Global's balance sheet here in the US. So there's speculation that they're going to make some fairly sizable acquisitions over the next year or so and deploy some of that capital. So we'll see how that plays out. But internationally, I think it can only be good. It can only be good because hopefully, with Francisco Partners, a new private equity player, they'll be more focused on driving that to profitability and trying to figure out how to service those countries better. It'll be interesting to see how that plays out. But I think it was sort of like a neglected asset within CDK Global. They had resigned themselves that it was sort of a distraction from where most of their revenue was, which is in North America. And at this point, I mean, I'm eager to see what Francisco Partners and this new Key Loop company they focus on to differentiate internationally.
Got it. Thank you.
Okay.
Anybody have any other favorites they want to ask Steve here before he moves on? I could probably sit here for a little while.
Yeah, the other one to call out is ACV. So ACV actually just IPO'd here last week. Last week. I think it was last week. Yeah, I lose track of time. But and very, very favorably received by Wall Street. So ACV is a B2B platform for used car transactions between dealers. And they've really been attacking what historically has been dominantly a market space owned by two physical auction companies, one being Manheim and two being ADESA, which is owned by Car Global, which is a publicly traded stock. Manheim's private. And they've made it very, very easy for dealers to list cars and trade amongst themselves. And they've got a lot of momentum there. And now as a publicly traded stock, which ironically is valued at about 4 times what Car Global is, despite the fact that Car Global is doing much more volume than ACV. But coming back to the 2 slides I showed before with Carvana's market capitalization versus the more traditional dealerships, and then Tesla versus the more traditional OEMs, I think we've got yet another case with ACV being rewarded based on their anticipated growth and their anticipated margins. They aren't profitable yet, but it's interesting. It'll give them more capital to continue to attack the incumbents, which are the 2 big physical auction companies. And so we're seeing disruption at the dealership level through Carvana and Kazoo. We're seeing disruption at the OEM level, if you want to call it disruption, with these new EV OEMs that are becoming public, many of which are on this chart, and most notably being led by Tesla. And now we're seeing sort of disruption of the physical auction companies by ACV. Like I said, it's interesting time in automotive for sure.
Thanks, Steve.
Yep, absolutely. And again, if you have any questions, don't be shy. So let's talk about trends coming to automotive. So I think that there's a lot of uncertainty, and again, these uncertain elements can be, causing angst within some, or you can be sort of just being zen and embracing them and finding that these things are going to energize a lot of change coming to the industry. But clearly, economic change, not the least of which is consumer preferences, as I said, consumers' preferences really around convenience, and anticipating those and trying to address those are going to be differentiators for OEMs and dealers. Process automation and efficiency. I think that whether you're an OEM trying to automate the production line or squeeze efficiencies out of your suppliers, or if it's trying to, there are articles, I think as of this week in Automotive News around, I think it was Mercedes-Benz greatly reducing the permutations of their vehicles to try to find efficiency sort of in their supply chain. And as a result, there'd be far fewer trims and permutations of S-classes, for example, which makes it a lot easier for the dealer to stock the right vehicle to ensure that they have the right cars in stock when consumers come in. And then trends towards fleet ownership. I think that autonomy aside, and even subscription aside, I think that we're going to see more and more ownership by fleets in the future, and trying to figure out how do they convert consumers who otherwise in the past may have wanted to own cars to more of a flexible ownership model. And then we talked about new business models as well, a number of which on the previous slide. There's regulatory change coming. So, I think we're seeing a lot of this, with a new president in the White House in terms of top-down stimulus, a little bit anti-oil, a little bit anti-internal combustion engine, embracing, EVs, but also the infrastructure to support EVs, and autonomy, smart cities, and emission standards, as I say here. And, other regulatory change that I believe will be coming is, I think that the Consumer Finance Protection Bureau the CFPB here, will start to get more teeth and start to probably regulate finance and insurance products at the dealer level. And I think, you know, ostensibly to protect the consumers from predatory pricing, et cetera, I would imagine we'll see that play out over the next couple of years, and then we'll have tension. A lot of technological change. We'll get into that in a few minutes, but not the least of which is connected, autonomous, and electrification. And I've got a slide or two on that. And then I think just social change in general. I think that you know, sustainability is a way that some OEMs are going to evolve and offer like a differentiation. I wasn't sure, I don't know if there's anybody from Volkswagen on the call today. I would imagine they wouldn't be willing to share anyway, but I presume, you know, the press that came across the wire yesterday about Volkswagen changing their name to Volkswagen was actually a premature April Fool's Day joke. But I don't know that. Maybe I'll offend someone by saying that, but I can't imagine Volkswagen is going to change their name to Volkswagen. But I mean, stranger things have happened in life. But I mean, just an example, maybe not a good one, but an example of, you know, OEMs trying to recast themselves as being more environmentally friendly, embracing EVs at a more rapid pace. And we've heard that from a number of companies recently, not the least of which is General Motors. Just to do a time check here. How are we doing for time? Good?
Yeah, I think we're good.
We've got 25 minutes left.
Okay, great. So plenty of time. So here are big themes, right? So I would say that, you know, I stole this slide from CB Insights, so kudos to them. I should have references at the bottom. But, you know, I think that many people talk about CASE, C-A-S-E, or ACEs in terms of connectivity and autonomy, changes to subscription and electrification. This branches out a little bit more, but I think these are the themes or the lens through which we can see a lot of innovation happening and a ton of investment. So I think that whether you talk to private equity firms or VC firms, or even the corporate VC arms of the OEMs, many OEMs now have, you know, are putting their own money into startups to sort of either diversify and hedge, or as a way to, you know, fuel R&D and learnings for the sort of like the OEM corporate body. So I would imagine many of the folks on the call today have corporate VC arms that are very active. Some are very, very active. Toyota, for example, has just recently announced, you know, multi-billion-dollar investments into technologies. But I think that this is probably a good lens to look at, whether in the upper left-hand corner, electric vehicle technology, and this spans everything from the battery technologies themselves. There are many companies working on really fast charging technologies right now. There are many companies looking at solid state batteries and trying to figure out, you know, are we going to deplete, you know, for example, there's been precedent in the last month around depleting like lithium reserves for lithium batteries. So I think the battery technology's got to change in terms of like the chemical makeup of the battery, but then also how quickly we're going to be able to get charge into the battery. And then there's battery technologies around, are we going to be able to swap out batteries? You know, I had conversations with a VC just last week about sort of the depreciation curve of a car is quite different than the depreciation curve of a battery. And one of the VCs I talked to last week figures that at the end of life for the car, the battery will be taken out and there'll be a secondary usage for that. It may become a battery that we put into the house to feed and take us off the grid. So the life of a battery could potentially be a lot longer than the life of a vehicle. And we may have to sort of residualize it, if that's the right word, amortize the life of the car differently than the battery. And you may in the future, you know, be able to reclaim the battery at the end of the vehicle life, which is kind of interesting. So as you can imagine, there's a whole bunch of companies and innovation in the electric vehicle area. Autonomous in the very middle at the top. You know, this is where it's everything from smart cities to enable, you know, cars to communicate with the cities, to help with traffic flow through cities and keep pedestrians safe, to cars communicating with each other, to, you know, cars communicating with the passenger to make their life more convenient, to cars, you know, analyzing and predicting when key components might fail and getting that car into service at the right time, all the way to, you know, the cars actually communicating back down from the OEM to the consumer. So between connected vehicle tech in the upper right-hand corner and autonomous vehicle tech, it's an interesting time. Autonomous is here for commercial vehicles. And, you know, we're seeing, you know, evidence of commercial vehicles now on the road, and we're going to see much more of that over the next few years. There's a lot of miles being logged with consumer autonomy. Don't know when that will become mainstream, but there was an article out, I believe yesterday in Automotive News about Yandex trying to figure out how to allow autonomous cars navigate around snow in Russia. Because I mean, there's a reason why most of the autonomous miles have been logged in sort of Sunnyvale and Phoenix, because the weather's always the same and there aren't clouds and there isn't snow and there isn't rain, to try to remove as many confounding variables from the sensors on these vehicles. But as you layer in rain and potholes and traffic and construction, it gets much more complex for these vehicles to protect the not only the passengers in the car, but also the pedestrians on the road. So it'll be interesting to see how this plays out. But we'll see. I think it's pretty commonly accepted that we'll see the commercial application for autonomy here much more soon than humans. But I think for slow-moving vehicles, we will see a lot of applications for humans being transported via autonomy. In the lower left-hand corner, I guess, lower left-hand corner, talking about auto commerce. We talked a lot about Carvana and Kazoo. I do think that, and then ACV, the digitization of commerce, be it either B2B or to consumers, is very interesting. And there's billions of dollars, searching these new solutions. I think it seems intuitive to me that, like I said earlier, driveway delivery of cars and servicing of cars, et cetera, is interesting. I think in terms of the subscription model or different means of ownership, I think that companies have been more challenged. We've seen very large, well-capitalized companies such as Fair, I think, really struggle with how to convert what is otherwise ownership to a subscription model. There was an article out, I think this week, in Automotive News about Porsche having success with their subscription model. But that article also goes into detail about how all of the other luxury brands have closed down their subscription models. And the problem with a new car, I mean, I'm preaching to the choir here with OEMs on the call, but the problem with a new car is that you have such depreciation in the first year that it's really hard to amortize that unless you have like a 3-year lease and spread that over three years of payments. If you allow the consumer to take a new car and literally swap out of it, on a monthly basis, it's really hard to figure out how much that consumer will pay. I think Porsche is a little bit of an edge case simply because the buyers are rather price insensitive. And I suspect that when you peel back the Porsche program, they see it as a marketing expense. There is a Porsche executive who's cited, I think, in that Automotive News article, that they try to convert those consumers eventually to buying a Porsche. So they're allowing consumers to sort of like buy a $1,500 or $2,000 a month subscription product where they can swap out different Porsche models at their convenience. But at the end, they are trying to then eventually convince that consumer with such a great brand experience to buy a new car. So we'll see how that plays out. Bike and scooter tech isn't an area I spend too much time in, but mobility, especially within dense urban areas, as cities start to close down certain streets because of congestion and air quality to motor vehicles, especially like internal combustion engine vehicles, I think we could see sort of more widespread use of bikes and scooters, especially within those cities that have warmer climates. And there's been a lot of investment there. And then we talked a little bit about mobility as a service. I think that companies that haven't been profitable, such as Uber and Lyft, I do believe their long-term plan is that at some point when autonomy becomes standard, they will flip to being a positive profitability company, simply because right now, if you have humans driving the cars, the margins are really, really slim. If the cars can drive themselves, the margin for these kinds of networks of ride-hailing services should be much more profitable. But that's probably a longer game, given that I don't presume that autonomy is going to be something that's widespread for consumers anytime soon. So any questions on that at all? Again, don't be shy about submitting questions through Q&A. Great. And then finally, I mean, looking forward, I think that, you know, a lot of those same themes still persist. I mean, I think that, you know, the electrical vehicle manufacturers that have hit the market and become public this year seems to be a sort of a torrid pace, and not some of them not without scandal in terms of whether they actually have businesses or not. But I think that Tesla's very high market capitalization, combined with what seems to be an environment in Washington that's going to really embrace EVs, is fueling a lot of interest in electrical vehicle manufacturers. And then you can see visibly, you know, whether it's Volkswagen, and I joked earlier a little bit about the name change, but whether it's Volkswagen or GM or these other legacy OEMs, they're, you know, obviously spending a lot of time in their boardrooms trying to figure out how they stay relevant and potentially pivot the entire company to 100% EV. I think that I just saw this week that Volvo will be 100% EV, or have claimed to be 100% EV by 2030, which isn't too far off. Commercial vehicle innovation. This is probably one of the more interesting spots right now. I mentioned that autonomous coming to commercial, but in terms of Internet of Things and connected vehicles, the commercial vehicle innovation that's going on is intriguing to me, in terms of trying to you know, anticipate when key components will fail on commercial vehicles, combined with autonomy, combined with, there's a bunch of companies that are either trying to build EV heavy trucks or try to retrofit internal combustion engines with either hybrid technology, which extends the fuel economy of these vehicles, or swap out, you know, what was historically internal combustion engines with EV technology. So there's a whole bunch of technology and innovation going on in the commercial area right now. We talked a little bit about sort of like the investment in robo-taxis or autonomous vehicles for consumers. And I think if you look at sort of Waymo raising a ton of money last year, and Cruise out there funded by GM making acquisitions recently, there's obviously a bunch of innovation and money coming in to try to figure out what the future of autonomy will be to transport consumers around. We talked a little bit about micro-mobility, but I would suspect there will continue to be a lot of investment in that area. And then the digitization of the dealerships, we haven't spent too much time. It's an area that I actually spend a lot of time, but there's a whole bunch of companies now that are helping dealers sort of address and cater to consumers that don't necessarily want to come into the dealer any longer, or want to have more control over configuring their car deal online. And I'm sure, you know, Kim and Motive Retail work with a lot of these to ensure that they're integrated and getting the data that they need and integrated back into the DMS systems. But this is an interesting tension between control, because I said earlier, I think there isn't an OEM who doesn't want to offer a better differentiated car shopping experience online to their consumers. And if you go to any of the OEM websites and shop for a car, they're all very beautiful, have great car configurators, differing levels of transparency around a payment. You know, can I get a lease or finance? What's my personalized payment be? In many cases, the OEM simply dead end you. You know, you configure your car. Do you want to go find inventory from dealers and hand that off to dealers? But you know, at this point, that experience on the OEM websites quite often, almost consistently, is very different from what a consumer then gets when they go to that dealer's website of the same brand. And the OEMs want to harmonize that experience. I think the dealers are up for harmonizing that experience as long as they don't lose control over their relationship with their consumers and their ability to establish that relationship and encourage that consumer to come into their store to buy from them and then service from them. So I think that we will continue to see, whether it's through, as I said earlier, connected car data and who owns the consumer post-purchase. I think also in terms of the shopping experiences on a dealer's website versus an OEM website, I think there will be pressure to harmonize that and make that sort of seamless. But I think that there will also be tension, because through that process, there'll be, I mean, for example, I remember reading an article I think in November about the new Hummer, the GM Hummer. And there were dealers that were pushing back against GM because GM was trying to encourage consumers to go to the Hummer website, configure the car that they want. And then the OEM, you know, GM in this case, would decide which dealer was going to be the point of delivery for that Hummer. And I think it's interesting tension as more and more consumers, configure these cars online and don't ever want to go into a dealer, how will the OEM work with the dealer to make sure the right dealer gets kind of inserted into that shopping process at the right time? And without harmonization of the dealership website experience with the OEM website experience, I think it's necessarily going to be a bit disjointed and confusing to the consumer. So I would suspect that the OEMs and the dealers that work together to figure that out are going to have a differentiated expectation and experience and should be able to take market share. And I think with that, I'm to my last slide. So I mean, no surprise here. As our company looks to make investments in areas, there are some areas that seem to me to be areas to sort of allocate investment with the hope that we'll get outsized returns. So let me just walk through these quickly, and then if you want to pause and dig into any of them, happy to do so. But you'll see that these largely mirror the themes that we talked about earlier. I'm particularly interested, as I said, about online vehicle purchasing and financing specifically. I think we're going to see a lot more innovation. Well, I know we're going to see a lot more innovation in the next couple of years, giving consumers options to refinance their car at a lower rate, to come up with financing ahead, almost like financing first before you connect with vehicles. I think the car shopping sites in the past have largely started with inventory. What car do you want? Let me help you find a car. And then, financing or leasing or the monthly payment and affordability was an afterthought. I think many more of these experiences now will start with, let's figure out what you can afford. And let me only present to you vehicles that you can afford. And I think we'll see a lot of innovation and a lot of spending in that space in the next year or so. Alternative ownership models, subscription, et cetera. I'm not convinced yet for new car subscriptions that it's going to work. Largely because, like I said, there's so much depreciation of a new car in the first year. I don't know how you can give the consumer a super short-term ownership or lease experience without charging them a monthly payment that they won't bear. But there are companies that I meet with frequently that are trying to figure this out. I think on the used car side, it's much more likely that we'll figure out good, flexible subscription models for consumers to sort of subscribe to used cars. Around micro mobility, I mean, I have no doubt that cities over time will migrate towards starting to close off certain areas to be either pedestrian only or they'll have scooters and bikes. I think there'll be an opportunity for these micro mobility providers to partner with cities to figure out how best to get consumers around efficiently within those cities. But I think this will apply mostly to like very dense urban cities. Zero emissions. I mean, clearly we're seeing it now. We're seeing billions of dollars in these EV OEMs that are coming to market, becoming public companies. But I think that right now we'll see how the next 4 years plays out with the Biden administration. But it seems either investments in EV charging infrastructure to ensure that as we add more EVs to the road, we have enough charging infrastructure to keep these cars circulating, or the technology themselves. And there's a whole bunch of other knock-on investments that can be made around, like I said earlier, battery technology, fast charging of batteries, the raw constituents that go into batteries. So I think that whole area is fascinating to me. Ride hailing, there was a short-term COVID impact, but I think as we get to the 200 million plus US population that gets vaccinated, I think we'll get back to sort of like a semblance of normalcy with people getting back to airports, and business travel will start to come back, and people will start to have faith in going on vacation and going to hotels. And I think part of that will be people will feel safer hopping into Ubers and Lyfts. But as I say in the last bullet point there, I don't know if this is commonly held, but I truly believe like the Uber and Lyft models may never actually see profitability without a switch to autonomy at some point in the future, and who knows when that's going to come. So the autonomy argument, as I said, I think at the beginning of the presentation, the aggressive adoption forecasts were overhyped a little bit, but there's a lot of uncertainty. I do think that there are some really, really well-funded big players like Cruise and Waymo out there who are ahead right now. But I think that what we are seeing is wide adoption of crash avoidance technologies that are keeping passengers safer. And as cars become more connected, and we have more of these sensor devices on vehicles, I think cars should just naturally become much more safe, which adds to a whole new level of complexity. You know, cars will become more expensive. When there are minor accidents, we might have total write-offs of vehicles because these devices that are in the bumpers are going to be so expensive to replace that the car becomes really a technology device at that point. And then finally, connectivity. I think I've talked a lot about this, but this fascinates me, but I don't quite know how this is going to play out in terms of, there may be folks on the call today from the OEMs who have a point of view on this, but I mean, I'm very interested to see what the in-cabin experience looks like for consumers going forward. Like, for example, I'm not a Tesla owner, but I've got a buddy, a close friend of mine who owns a Tesla. And it's kind of interesting to me, very slight use case, but as I thought about it, we were traveling somewhere. He emailed his Tesla the destination of where he wanted to go. And when he hopped in the car, the Tesla had already picked that up and had it on the GPS device. He didn't have to do anything more. And that's kind of interesting. To me, it was like minor use case, but I mean, I can only imagine like a legacy OEM, the challenge they would have with integrating the software needed to do that with the hardware. Whereas, Tesla fancies themselves as a technology company. It was probably not too much of a lift to figure out how to integrate that because they own the software on the actual technology stack in the vehicle. Whereas, I think that the legacy OEMs are going to be at a greater disadvantage with trying to figure out how you have these little delightful, pleasing experiences for the consumers in the cabin. And they're going to have to work, I think, very closely with the tier 1 and tier 2 suppliers to make sure that they can keep up with more of the pure technology players like the Teslas and these other EV manufacturers coming out. But there's no doubt to me that, from a connected car standpoint, there will be billions of dollars made, but it's hard for me to think through who's going to win right now because it's not clear to me how, what the use cases are going to be that are going to be really of value to the consumer. And I think with that, we're at time for Q&A. So Kim, I don't know if any specific questions come to mind for you through that, or we just want to go to the audience.
Well, the audience has been kind of quiet so far, Steve, so maybe let's give them a shot before I babble on. Anybody have anything that they'd like to ask Steve? And look, if you haven't, just a quick plug here for Steve and the work that he does. Check out automotiveventures.com or otherwise follow him on LinkedIn. Steve puts out an enormous amount of content. I don't know how he keeps up. His monthly newsletters are must read. And so, and all of that is available. And I know, Steve, I think you'd be happy to, take any, direct inquiries if folks have questions, but I definitely encourage you guys to kind of follow, the information that Steve's putting out there, because this stuff is changing fast, and it's a pretty dynamic, marketplace out there right now.
Thanks, Kim. No, I appreciate it. Yeah, I'm just trying to, if you have feedback at all on the newsletter, happy to, entertain that. And it's ever evolving. So trying to provide value to the industry. But I see a question from Paul asking specifically about Techion, and Kim, maybe you and I can tag team this one. So for those of you that aren't familiar with, so let me read Paul's question. So he's saying, in reference to DMS suppliers, there's been quite a lot of hype around Techion entering the DMS supplier market. His question specifically is there any evidence as yet that they are any sort of a game changer in the space? Do they have any major USPs? So I think that, so I'll have a go, and Kim, you can pile on here. So yeah, I mean, Techion has a lot of hype. I mean, to use your term, I think that, you've got the ex-CIO of Tesla, who's come into the space, seeing, okay, we've got two big incumbent players and a lot of revenue being generated. So to put that in perspective, I mean, Kim can keep me honest here, but I believe that of the 18,000 franchise dealers, probably their average DMS spend per month is $10,000. Mm-hmm. I don't know if you have a perspective on that or not.
No, I think that's about right.
Yeah, by far, if you look at all the SaaS products that a dealer spends, I mean, the DMS line item is by far much bigger by magnitudes. I would say that the next biggest line item is probably their CRM. and their CRM might be somewhere between $2,000 to $3,000 a month. So you're talking about 3 times the magnitude to 4 times the magnitude. So it's definitely, if you were going to come in and try to disrupt anything, you would look at the DMS and say, okay, well, that's a big addressable market, right? It's a good story for investors to get behind. And in terms of your specific question, I mean, I think that there's the potential that Techion is a big game changer, right? Everything they're saying is much more aligned with how any contemporary technology company would attack the space, much more about sort of software as a service, open integrations, making sure that they're fostering innovation, doing it in a way that's much more pleasing to the users, the dealer employees, in terms of use cases and the interface. But also the flip side is like fostering innovation at a much more rapid pace. So whether it's like we talked earlier about digital retailing tools or whatever it might be, I think that Techion came out recently. Again, it seems like I'm a shill for like automotive news here, but it is one of the best sources of data. They talked about sort of how Techion will be powering, I think, GM shopping experience for one of their new EVs that's coming out. So it's definitely one to watch. I mean, I don't know. I don't know in terms of traction so far, in terms of like how many dealers and how far along they are with like features overall. But it is one that I personally am trying to pay a lot of attention to. But to be perfectly honest and transparent, I haven't yet gone and sat down with a dealer that's using Techion and has switched off of their historical DMSs to Techion. But I look forward to starting to spend time with dealers to understand that. So Kim, I don't know if you have anything to add to that.
Yeah, no, I mean, I think the only thing that I would add is it's early days. And it's a it's a big, complicated market to break into, and I would agree with everything Steve said in terms of the story, but I think it's early days still in terms of getting enough traction to really have a marked impact on the market.
Okay, great. So another question from Steve. He asks, as I think about integration with DMS vendors and the direction of technology, in parentheses, microservices and APIs, for example, why should I spend money to integrate with the big DMS vendors and their outdated ways and business model? So Kim, you might have to be more politically correct than me. I don't think I have to be. So, and let me start here, and then you can reach out and kick me through Zoom if I'm out of line. So interesting. This is definitely an area that Kim has far much more expertise than me, but I have been in the industry for 20 years and have overseen a lot of acquisitions of companies where I had to go negotiate with these DMS companies for some of these integration agreements. And I think that historical perspective here, and again, I'll be stating the obvious, but I think the DMS companies have seen their data agreements where they effectively charge the vendors to integrate with them as being very large profit centers in the past. And they've left a bad taste in the mouth of, and this is only like generalizing about a couple of DMS providers that will remain nameless, but they've left a bad taste in the mouth, not only for the vendors and stifled innovation in the space, but I think also, those costs effectively end up being borne by the dealers who buy the vendors, right? So the vendors may have to cut big checks to the DMSs for integration fees, but then, eventually the dealers end up paying for those. So it's kind of a pass-through. So ironically, to me, it was always that the dealers who buy the DMS and pay the DMS companies eventually have to then also pay for the vendors to get these integration fees. Now, philosophically, things have changed. And with this, I'll pass it off to Kim. I think that, we've seen one of the big DMS companies philosophically change quite a bit. And open up quite a bit and be more open-minded about it. I think that, coming back to Paul's question before, I think Techion in some ways, interestingly enough, will keep these big DMS companies honest, because the fear of a disruptor coming in will keep them honest with the way that they treat customers and other integrations. But it is interesting. And obviously I have an opinion on this. If you ever want to catch up offline, I don't know who else is on this call today. Happy to chat about that and how that's evolved over time. But with that, I mean, that may have not been exactly the answer that Kim wanted me to give. So go ahead, Kim. And
yeah, no, it's all good. And look, guys, I think we could probably spend a whole hour and more on this topic alone. And I'm conscious that we're kind of at the end of our time. I think perhaps one short answer right now, Steve, is that today, there is the the fact is that these vendors that I think you're referring to are dominant in many OEMs networks. And in order to move initiatives along, you know, they have software that your dealers use, and there's no getting around that right now. So that's one short answer. But you know, thank you everybody for the questions, Paul and Steve. Perhaps there are others, I'm not sure. But I think, as Steve says, let's if you want to you know, follow up with him directly, you can grab his contact details, and we will share both this recording as well as the slide deck. And I think both of these are probably great topics for more discussion in these webinars that we're doing. And if anybody has other ideas, please let us know. And I think, yeah, we probably need to call it good here for today.
Thanks everyone for joining.
Steve, thanks again.
Thanks for having me. It was a great discussion. And thanks everybody out there.
All right, great. Bye-bye, everyone.